So with another week of trading in the books, Herwig, I think it's time for us to cover our main topic, which centers around an obscure rule in private securities liquidity that can play a significant role in the liquidity of security tokens that leverage U.S. private fundraising exemptions that we covered in just last week's episode. So if you haven't listened to that one yet, I would highly recommend checking out at least the main topic, which is posted separately on our YouTube channel via the Security Token Show Highlights playlist. But this week we wanted to cover Section 12G of the Exchange Act of 1934. And this small section applies a limit to the number of shareholders, or as they refer to it in the legal documentation, record holders, that a private security can have before the issuer needs to publicly report its financial statements to shareholders and the SEC. Section 12G caps the holders of record at 2,000 people, which created a multi-year discussion in security token circles regarding whether this section could kill public ownership of security tokens, potentially crushing any dreams of liquidity for these assets. However, what has been determined in reality is that the term record holder is not directly synonymous with investor. In the same way that you don't technically own your shares of stock purchased on brokers like TD Ameritrade, which custody on your behalf when dealing with exchanges, security token ATSs and marketplaces can represent the record holder of a security token on behalf of its investors, allowing just one record keeper to be present on the ledger.
All right, so basically when it comes to using secondary markets for security tokens, like broker-dealer managed markets like Open Finance Network or regulated exchanges like Merge, they're the ones considered holders of record in the eyes of the law, and when they themselves manage their own registry of investors on their own platforms. So these brokers are often referred actually as the street name on the ledger. And so T0 or Merge would be the street name on record as the beneficial owner, and they themselves could have tens of thousands of investors in their own registry. With this, it actually doesn't seem that way that Section 12G will create a huge problem for security tokens. But unfortunately, that isn't just not quite really true. You see, the big issue for security tokens and Section 12G is self-custody.
So when you say self-custody, you mean an investor who has their security token sitting in their own personal wallet, at which point they have the freedom to then interact with any exchange or liquidity provider, offering exchange services, custody, staking, or maybe other opportunities.
That's right, Kyle. Self-custody is one of those cool benefits of security tokens because as an investor, I have full control, right? I can sell it peer-to-peer directly to someone without any third parties involved, or I can move it to another marketplace. But right now, maybe I don't want to sell it, so I could decide to self-custody. But therein lies the issue. Okay, because the moment that the 1999 investors or 500 non-accredited investors have self-custodied, you've now triggered that Section 12G. Essentially, self-custody creates a real challenge for issuers looking to avoid registering with the SEC. The best way to solve for this is to have cross-protocol support between marketplaces for the security token and, to restrict self-custody so that investors can basically only move between street names and it doesn't ever become a beneficial record holder on the cap table, the capitalization table, the registry, the ledger, creating artificial constraints, essentially preventing the limit from being broken.
Yeah, so I think in layman's terms, if you want liquidity, self-custody just isn't going to work. In principle, if all participants are on the blockchain, smart contracts using atomic swaps could prevent that limit from being broken and still give up to, say, 1,999 individuals or 499 non-accredited investors. They would have the ability to self-custody maybe by either setting a minimum size requirement or using a custodian that can act as a street name exclusively. Atomic swaps are currently being leveraged by Securitize for their instant access platform, which we covered in great detail in episode 41 if you want to check that out.
Unfortunately, these limits were just installed thanks to the amendment actually by the Jobs Act of 2012 to that rule. So regulatory reform probably isn't going to come anytime soon. We will see what best practices ultimately result from this, and it's possible the industry players will come up with a solution of their own. But as it stands, U.S. issuers Section 12G will create a problem when it comes to self-custody for security tokens.
But it definitely does not prevent liquidity, and it definitely doesn't prevent you from having more than 2,000 investors. You just need to kind of force them to trade with a street name or an exchange, which requires centralization that's somewhat against the ethos of decentralized finance, but I think we can persevere.
And that's pretty much all there is to it when it comes to STOs and Section 12G. Hopefully, you wonderful listeners found this segment useful and helpful. If you have any questions, feedback, or maybe even main topic suggestions, let Kyle or I know. We're active on Twitter or LinkedIn, or submit a thread directly on stomarket.com/news so the community can also participate.
Thanks for listening to the episode this week. Don't forget to check out the videos on any main topic we covered in the past that you may have missed. It's all organized by topic on our YouTube channel. Talk to you next week.
Thanks for listening.